Hello, everybody, and welcome to our Module 14 session for Managerial Accounting, Standard Costing, and Variance Analysis. This is part 1 of 2 of this module. Now, we're getting close to the end of our 15-module session, and this week we're covering a continuation of the budget discussion, only now it's more of a budget on a per-unit basis. So this is where Standard Costing and Variance Analysis comes into play. So, for an overview, we're going to see that management needs to have certain information about how their budget compares to the actual results in order to perform the control function of managerial accounting. Again, it's all about comparing the actual results that come in to what standards we have set, so actual to budget. Now, the idea here is that this drills down to the individual cost center, profit center, revenue center, and we can identify what that manager should have been in charge of, what they should have been accountable for, and how well they did compared to budget. Now, there's a phrase or concept called management by exception, and what we're basically saying is in many organizations you can have multiple levels all the way up to the top. Top-level management, they don't need to see the specific details of every single level of the organization. Now, that's not saying they shouldn't have access to it, but it's saying they shouldn't be focusing too much on that level of granularity. Again, unless they specifically have a need to see those details, each of the mid-level managers are going to see the details of their own responsibility center, and they'll summarize the data for their one over, their manager, and all the way above. Now, the idea of management by exception is basically focus on what is not going right. Now, that sounds negative, but what we're saying is if everything's going right in certain areas, there's not a whole lot you need to focus on. There's no attention you need to pay to that other than to congratulate and recognize the people, but there are no changes that need to be made. That's the point. If something's not going right, that's where you need to figure out what do we do to correct it, and something requires some sort of adjustment. Or it might even be the budget that's out of whack. Maybe the budget itself needs to be revised to more closely reflect actual results. Now, when I talk about these responsibility centers, I gave a few of the names earlier. Cost centers, the managers in these type of responsibility centers are just accountable for keeping track of their costs and keeping the costs at a reasonable amount. These are areas that don't sell anything. They just provide support to the overall company. So the accounting staff, the maintenance, production departments, they serve a very important purpose, but there's no revenue to track. So the only thing they track is cost. Revenue centers are they're basically the opposite. This is our sales area, reservations department. Their goal is to keep revenues high. Now, they don't track costs. They're not really responsible for costs. That's not saying they don't have costs. And yes, they'll have a cost budget. They have salaries. They have depreciation. But that's not their main focus. Revenue is their main focus. On the other hand, the profit center. These managers are responsible for both keeping costs low and keeping revenues high. Therefore, they're keeping profits high, or at least above budget or at budget. So this might be an example of like a fast food restaurant in a big chain. The manager of that one store is responsible for food and labor costs as well as generating more sales, having people come in and try out the food, customer service, all of that. So they're responsible for both. The fourth responsibility center that we have is the investment center. And the idea here is that this might be like the corporate headquarters of this big fast food chain. They're responsible for properly investing all of the profit from those related profit centers and earning a high return on that investment. Maybe opening a new store, introducing a new product line, whatever they have the idea to do. So now we're going to switch gears and we're going to talk about the actual detailed concept for this week, the standard costing. So first of all, we need to know what is a standard, and it's basically a budget on a per unit basis, a certain number of pounds of materials for each product, a certain number of hours of labor. Those are the standards that we're talking about. and they lead to the overall budget. They're the detail that allows us to meet the overall budget. So the way standards can be set, there are really three types. I mean, you might have heard of other names, other types of standards. These are the three generic types or general types. The first one is known as the ideal standard or the perfection standard. And the idea here is that this is if everything was to go perfectly according to plan. Nobody was ever sick, nobody was ever slow, the machines were never down, materials were never backlogged. If everything went perfect, maximum perfection, then hey, we'd be able to hit this standard. The problem is in reality, something happens, things aren't working perfectly according to plan. It's a nice idea. It's something to kind of a moonshot. It'd be great to get there. But having people's performance reporting constantly reflect failure because they cannot meet this perfection standard tends to demotivate people. Past experience standard, this is basically saying, hey, whatever we did last year, let's try to do that again. And the problem with that is, first of all, who's to say last year was really a good year? Maybe if we challenged our staff a little bit, we could do even better, just a little bit better. So an attainable standard is kind of the best of both worlds. It's a challenging standard. It's maybe some increase or improvement over the prior year, but it's still attainable with a reasonable amount of issues happening throughout the year. So it's not perfection, but it's challenging, but it's reasonable. So now we're going to talk about the static versus the flexible budget. We use the standards to help us generate a budget, but we're going to see the difference between these two. With the static budget, we set revenues and costs based on a predetermined level of activity. For example, we think we're going to have 90,000 units produced throughout the year, so we'll set our revenues and costs based on those units. But if we actually produce and sell 100,000 units, it's obvious that both the revenues are going to be higher and many of the costs are going to be higher. But under a static budget, we take the actual results that were based on 100,000 units and we still compare them to the 90,000 unit level, which really, you can imagine that results in skewed comparisons. You might be penalizing a manager for having quite a bit more materials than were budgeted, when in reality, the reason they had so many more materials is that they produced many more units. So it's expected that the materials would increase. The static budget does not consider any of that. The flexible budget does, and in fact, that's its entire purpose. It's to flex the budget, flex the static budget, to bring it to the new level that matches the actual level of activity. Now, we're not saying we're just adjusting costs and revenues to match exact results, exact actual results. That wouldn't make any sense. We're bringing them up to what we would expect if we knew we were going to sell that many units. So to do this, we have to review the unit standards. How many pounds of material are expected per unit? How many hours of labor? What's the cost expected for each of those? And so on. Now, the thing that we have to remember here as well is that in our budget, we're going to have fixed costs that may not need to change at all when we flex the budget. And we're going to have variable costs that likely will change. They should change by their nature. So let's take a look at this example. We have a static budget here. Let's say we produced this budget based on 40,000 units. That's what we expected to produce. So for the materials, we expect 2 pounds per unit at $5 per pound. So when we take 40,000 times 2 pounds times $5 per pound, we get $400,000 expected. Now let's jump over to the actual results here and compare them cost by cost. Let's say our actual results were double. We actually came in at 80,000 units. Yes, it's a bit extreme, but let's say it happened. We're stuck in a static budget. Let's say the actual materials came in at 750,000. That's 350,000 more than what we budgeted for. So we would call that an unfavorable variance, which means it's negative, it's hurt. And I should not say negative because that'll cause confusion. It's unfavorable. It unfavorably impacts net income. That's the way to think about it. all variances are going to be listed with a positive amount. They're never going to have a negative amount in them. Instead, the favorable versus unfavorable is what tells you whether it hurt net income or helped net income. More cost hurts net income, it's unfavorable. Less cost is favorable because it improves net income. More revenues improve net income, less revenues do not. They hurt income. So that's the way to think about it. Now again, we are telling this manager they were $350,000 over budget and it's an unfavorable variance. If we put that in their performance report and said, hey, you did a horrible job, you're $350,000 over budget, their response right away, reasonably so, should be that we doubled our level of production. There's no way we could keep at the $400,000 material level. In fact, and I did this on purpose and made this a nice, easy doubling, it is very reasonable to expect that the doubled rate should have been $800,000. So it's reasonable to expect that manager to have used $800,000 of materials and been perfectly fine. They actually went below $800,000. So if anything, this should be a $50,000 favorable variance. Now keep that in mind because we'll see that in the flexible budget. With labor, we have expected 3 hours per unit at $15 per hour, and then again multiplied by 40,000 units. So we have $1.8 million of labor. We actually came in at $3.75 million, which again shows up as unfavorable on a static budget. With variable overhead, we had the 40,000 units times the same 3 hours of labor. They're allocating variable overhead based on direct labor hours, and the rate is $8 per hour. So again, they came in higher, shows up unfavorable. Now notice they had fixed overhead at $70,000. They actually came in at $75,000, so that shows up as a $5,000 unfavorable variance. With fixed overhead, there's no reason to believe that will increase within our relevant range, within our capacity. So assuming 80,000 units can still be produced in our factory with our equipment, there's really no reason to believe this should have changed. It might just be that something was more expensive than expected. So this one's a legitimate variance. There might be a good reason for it, but it's not going to be due to the fact that we increased the number of units. So let's take a look at this budget flexed. Now we're going to flex the static budget to what we would have expected had we known we were going to produce 80,000 units. Basically, it's just replacing, you know how over here we took 40,000 times 2 times $5 per pound? Now we're just doing 80,000 times 2 times $5 per pound. We're doing that all the way down, and we're identifying what our true costs should have been at that level. Now, the materials, we already said, it makes more sense for that to be a $50,000 favorable variance. They did a good job of keeping material costs down considering the increase in production. For labor, they did use a little more labor than we would have expected, even at that doubled rate. So that's $150,000 unfavorable. Variable overhead, so they used less variable overhead than expected, $120,000 favorable. Now we know it can't be due to the quantity of labor hours because that's 3 hours no matter whether we're talking about labor or variable overhead. So it must have been related to the rate we actually spent per hour, which we'll get to in more detail in a little bit later in the slides. Fixed overhead, again, there's no adjustment needed for that. So we were truly $5,000 unfavorable. But overall, when we net everything together, this company was actually $15,000 favorable. So good job. Now we're talking about variances. We've went through a few examples. It's the difference between actual and expected results based on the cost. As I said, they're always going to be a positive number, basically an absolute value. We're never going to treat them as negative. Instead, we look at how it impacts net income. Again, for revenues, higher is better. For costs, higher is bad. That's the reason we don't use negative numbers, because we want to make sure to look at how it impacts net income, and revenues and expenses impact net income in opposite ways. So favorable versus unfavorable is what we want. Now the total budget variance, we're taking the total difference between actual and budgeted amounts or standard amounts. But this is starting to set the stage for the standard variance analysis calculations that we're going to talk about in part 2. We're starting to introduce it here. The total budget variance, for example, materials. The total budget variance could be caused by two things: either the price per pound or the number of pounds. The labor variance could be caused by the price per hour or the number of hours used. So that's the way to think about this. It's all about a price or a quantity. Now, what we have in this illustration is showing the two extremes: actual cost times actual quantity, actual cost per pound of material times the actual quantity of materials used. That's on the far left side. The far right side is the standard cost per pound that we expect, multiplied by the standard quantity allowed at that level of production, at the level we truly produced at. Now, if we just subtract those two, we get our total variance, but we want to know what caused it, the price or the quantity. So in the middle of this, we have to have one cost and one quantity. In fact, one cost and the opposite quantity. So one has to be standard, one has to be actual. Now, one could argue this could go either way. Actual cost times standard quantity. Mathematically, it'd still give you the same overall result. But when variance analysis calculations were developed decades ago, the thought was that for cost, we're going to use standard cost. For quantity, we're going to use actual quantity. Now, there is a good reason for it. We'll see it in just a bit, actually, in the next video when we talk about the true calculations of these. But we can see a little bit of it here. The price variance we're going to see is the difference between the two prices or costs: actual cost minus standard cost. And then they're going to end up being multiplied by the actual quantity we produced. So if we spent 10 cents more per pound than we expected, we're multiplying by that by the actual quantity we produced, and the purchasing manager is going to be accountable for that variance. They spent 10 cents more per pound, and they actually bought that many pounds, so that's going to be their accountability. Whereas if we use standard quantity, we wouldn't truly be holding them accountable, positively or negatively, for the full impact. We need to use actual quantity of what they truly bought. On the quantity side, to get the quantity variance, it's going to be the difference between the two quantities, actual minus standard, and it's got to be multiplied by a cost, but it's going to be multiplied by the standard cost. The thought is that the production manager, who's going to be accountable for the quantity variance, shouldn't be held accountable for a price that was above or below what was expected. They should be held accountable for the price that was budgeted. And really what they're being held accountable for is truly the quantity itself. So we've got 2 slides to wrap up part 1. We're going to continue to introduce the topic, and then we're going to come back in part 2 and see actual calculations. So what we need to know, if we go back here, we basically need to know each of these items: actual cost, actual quantity, standard cost, standard quantity. Whether we're talking materials, labor, overhead, we need to know the standard cost per unit, like pound or foot or hours. How much was expected per pound, for example? What was the actual cost per pound? For the quantity, we have to be very careful. We need to know the standard number of pounds that we would have expected at that actual level of production. It's not just one unit like the cost per pound was. It's not just what standard number of pounds were we needed to produce one unit. If we have that, we need to multiply it by the actual units we produced. We want to know how many total pounds should we have used for this level of production. We also need to know how many pounds we actually did use for this level of production. That's the difference there. Now, what I will say is that some problems give you the specific data you need, or they may give you pieces of it. Maybe they'll give you the actual cost per unit, standard cost per unit, but then maybe they just give you a standard number of pounds for one unit. Again, you'd have to multiply it by the actual number of units to get what you need. Some problems give you the total cost amounts, and you might need to back into the per unit cost by just dividing by the number of units we actually used. And again, some give you the per unit pounds, and you need to calculate the total amounts based on the actual level of production. So if you remember these 4 things, any problem you have, you need to figure out what these are before you really start the variance calculations. Now, the last piece I'll say here before we head out for part 2 is the variance terminology. I want to really reiterate the importance of understanding that it all boils down to a price and a quantity. Now, when these variance analysis terms were developed, for whatever reason, they strayed a little bit. They have alternate terminology depending on whether we're talking materials, labor, or overhead. But I really want to stress, no matter what they call them, it is a price variance and a quantity variance. Difference between the prices, difference between the quantities. The price variance is sometimes called a rate variance. A lot of times for labor, they don't want to call it a price for some reason, so they call it a rate per hour. Same concept. Sometimes they'll call it a spending variance. Sometimes they might just call it a cost variance. For the quantity variance, a lot of times it's called the usage variance. What quantity did you use? And efficiency variance, especially if we're talking about hours, labor hours, they talk about how efficient it is, but it's still the difference between the prices and the difference between the quantities, whatever alternate term they might be using for it. The model we're going to discuss in part 2, it works perfectly for direct materials, direct labor, and variable overhead. It's the same concept, the same calculations. The fixed overhead, however, requires a different model. One piece of it is actually much easier, and the second piece, it takes a little bit of understanding what's going on with it. It's not a tricky calculation, but the concept behind it takes a bit of time. But the bulk of what we're dealing with in part 2 is the same for these 3 different types of costs. That's the point I wanted to make. So that takes us to the end of part 1. We'll come back here in a few minutes and talk about part 2 in the next video. Thank you for your time.